This is Before and After from Refinitiv. I'm your host, Johanna Botta. The talk of the markets last month was a monster beat in U.S. payroll numbers. Will that trend continue? The reaction of markets could provide a huge clue for asset price returns in early 2020. The U.S. jobs market was perhaps the single most consistently strong economic indicator in the developed world last year, and everything from interest rates to the presidential election could depend on the performance of that jobs market. After the end of the General Motors strike had bumped up the November reading, a more tepid payroll number is expected for December. Now, it's also important to note that even before the U.S.-China trade truce was announced last month, we had already begun to see a rebound in the struggling manufacturing sector. Now, in October, the manufacturing payroll number fell 43,000, but in November, the sector added 54,000 new jobs. And overall, last month, the report for November jobs was a massive upside surprise. Now, non-farm payrolls data showed that the U.S. economy added 266,000 jobs versus an estimate of 180,000. This is consistent with the not too hot, not too cold growth rate that the market currently prefers. The market has become very accustomed to a strong jobs number, so we could see a diminishing effect on global risk assets if the number once again outperforms expectations. This month, we need to pay extra close attention to the average hourly earnings figure because inflation expectations could start to pick up if there are clear signs of wage growth. Gold is one potential asset price reaction to watch out for this week. Many people consider it a great inflation play, although it's been tracking yields, especially real yields, for much of the last 10 years. Last month's stellar jobs report saw gold sell off more than 1%. But over the last few days, geopolitics has given the precious metal a little bit of momentum. The latest gold bull move could be linked to the fallout from the U.S. military strike. Now, if we look closer, the expanded balance sheets of central banks could also be a cause of the recent surge in gold prices. Gold has been following the path of inflation-linked securities, such as the U.S. Treasury 5 to 10-year TIPS. When bonds rise and both nominal and real yields fall, and FYI, real yields are inflation-adjusted yields, then gold rises and vice versa. So if we get another strong payrolls print, then U.S. bonds could sell off, pushing nominal and real yields higher. That could allow gold to pull back farther from its recent highs, which would provide the sort of pullback that a gold bull would want to utilize to initiate or add to a position. On the heels of a landslide victory by the Conservatives in last month's British elections, it feels like a bit more stability and certainty is now seeping into the market there. This week, we'll take a look at UK construction data. And although this is a November figure taken from before the election, the market reaction will offer us a great glimpse at real investor appetite in the UK. The October number was very weak, as it declined 2.3% month over month, much weaker than the anticipated fall of 0.2%. And the November reading out this week is expected to bounce back with a 0.6% month-on-month increase. The election should prove to be a turning point for sentiment. Remember, this is a pre-election number, so if there are any market weaknesses on a bad print, then we want to use that as a buying opportunity. And the jump in shares of the UK home builder Taylor Wimpey shows you just how enthusiastically investors had bid up the residential sector after the Conservative victory was confirmed. The stock jumped from 174 to 199 on the day after the election. That's an 8% rise in a single day on huge volume. You kind of have to have respect for that sort of upside volume when there is a constructive trend in place. This stock and the sector have probably gotten ahead of the real fundamental picture for UK residential construction. Another horrific reading on the construction number should offer a short-lived opportunity on the downside. Expect the buyers who bought 100 million shares on December 13th, that's the day after the UK election, to re-emerge on any real pullback of more than 5%. But a big sell-off on a strong reading, which would show the economy is already starting to match expectations, would indicate that the sector could be in for a bit of a longer pause. The non-manufacturing ISM number came in stronger than expected at 55 versus a forecast of 54.5. This was the strongest number in 4 months, and the business activity gauge that we highlighted in the last episode had a very strong rebound of 7 points to 57.2, a bounce up from the 10-year low registered last month. And what did U.S. Treasuries do? At first blush, though not a lot, the 10-year yields consolidated above the 1.81 level, and the 2-year 10-year yield curve, which had already come off 10 bips from a multi-month high, settled around 26 basis point level. For now, it looks like the geopolitical headlines are trumping the economic data in defining the very short-term direction of asset prices. There it is. U.S. payroll, UK construction, and U.S. ISM non-manufacturing. Refinitiv data throughout. This has been the Friday episode of Before and After. And as you can see, this is a massively important time. If you want to be alerted to the very latest market moves, first subscribe below and then hit that notification bell. We'll see you on Tuesday.